Welcome to the MUFG Global Markets podcast. I'm your host, Ellen Tang, and today I'm joined again by Glenn Schultz, who is the head of our agency mortgage prepayment modeling and strategy for MUFG. Today is Monday, April 10th. Glenn, thanks for joining us again on this month's show.
Great. Thank you for inviting me. I'm happy to be here.
Absolutely. So for this episode, I would like to discuss first prepayment and turnover outlook from you, and then also spend a little bit of time discussing your views on the mortgage basis against the backdrop of SVB and Signature Bank.
Sure.
So, if we're starting off with the remit data in March, that was released last Thursday on the 6th, and it looks like aggregate prepayment as measured by the Fannie Mae 30-year agency prepayment rate beat the business day count convention, increasing to 5.5 CPR, and the 15-year prepay reported around 6.8. And then if we shift over to look at the Ginnie Mae sector, the 30-year prepayment reported around 6.9, and then 15 years were a little over 10 CPR. So maybe first, let's talk about the March remit data and your view on turnover. Does the March data support your 8 to 10 CPR turnover view for the coming spring and summer home selling season?
Mm-hmm. Yeah, I think so. So when I view the month of March as a kickoff month for the spring home selling season, and generally speaking, seasonal factors are worth about 2.5 CPR from March to June. So March 30-year remittance data reporting a 5.5 CPR suggests a peak aggregate 30-year June prepayment of 8 CPR, which would be on the low end of our forecasted turnover range, for this home selling season.
Got it. And so right now, the tradable coupon stack has expanded to the widest, trading between a 2% and a 6% coupon. So the question really more than ever is how prepayment evolves to this aggregate. What are your thoughts with respect to the formation of aggregate prepayment here?
Yeah, that's a great point, because how it forms is going to be important. So I tend to look for what I refer to as the turnover coupon every month, as we're kind of going through our analysis of the prepayment data. And so that is really kind of the new production coupon that's closest to the prevailing mortgage rate as measured by Freddie Mac's primary mortgage market survey. Surprisingly, though, after the refinance wave, the turnover coupon, of which one selection criteria is new production WALA greater than 15, less than 30, is a little bit more difficult to identify than into the past. And this is due, for the most part, like I said, to the pandemic-induced refinance wave. In fact, the turnover coupon really does not exist in the new production coupon stack as yet, if you apply that WALA filter to it. So what happens is now I end up using the 5.5 of 2018. So that has a gross WAC of 612 and a 54 WALA. So that's really moderate, not new production, but it prepaid at a 12.5 CPR. And then seasonal factors imply basically about a 15 CPR in June. So if we consider the 5.5 of 2022, which really isn't, up to the WALA point yet, then we really need to begin doing a little bit of math to sort of put that together. So that coupon right now is running ahead of a seasoning ramp, kind of the PSA seasoning ramp is what I'm referring to, is sporting a 5 WALA and is got a 6.4 CPR. So an additional 3 months of seasoning is worth, say, about a 0.6 CPR, and the seasonal factor, again, is probably worth another 2.5 CPR. And that gets us to a 9.5 CPR, which is nearer the upper end of our turnover range forecast. So when I'm looking at these two sort of together and putting them together, I'm like, yeah, I think we can make that 810 number. But how we're going to get there is going to be very, very different with respect to the discounts and the premiums.
Got it. Yeah. So I was going to say your line of thinking has to have implications for the discount sector. So with that said, what are your current views on the discount sector?
Yeah, it does. And the summary here is that I think discount prepayment will be faster than the market is pricing. So with that said, at this point, I think I might be the only participant in the agency MBS market that thinks discount turnover is going to be, greater than 4. So you look at the discount space, it's really trading around the 4. Like I said, I think the number is going to be more than 4. So, let's look at the twos of 21 and 22. Again, we look at them 2.7 and 2.1 CPR respectively. And in there we're coming up with, 21, 13 Wallas. So just following the PSA ramp, crediting 0.2 CPR per month implies a fully seasoned prepayment rate, winter seasonal for the twos of 21, 22, of 4.5 and 5.5 respectively. So both of these cohorts imply a fully seasoned prepayment rate, that's priced above the market. And in the near term, June 2023, putting all of this together, I come up with a remittance speed of, we'll say 5.8, let's call it 6 CPR for the twos of 2021 and 5.2. So we'll call that a 5 for the twos of 2022. So both of those numbers are sort of on the right in the near term or the immediate term, much higher than sort of the 4 sub 4 long term that the market is thinking about. So I think when we look at those, we start to put together, kind of a story that says, like discount turnover may not be as low as what the market is pricing, and that means there's then some PO value in that space.
Got it. So your analysis really suggests here that agency mortgage prepayment rate reaches somewhere between 8 and 10 CPR during 2023 home selling season, with the discount coupons printing mid-single digit CPR, and then the par and premium coupons printing closer to a mid-teen CPR, which implies, there's more value in the discount sector than maybe the market recognizes at this point.
Yeah.
Yeah, that's interesting, Glenn. One thing maybe we can touch on before we wrap up this episode is I'd like to get your thoughts on the mortgage basis here, especially against the backdrop of SVB and Signature Bank failures. Do you want to dive a little bit into that?
Yeah, sure. Well, first, the FDIC now owns the securities portfolio of SVB and Signature Bank. And, there's a lot of concern in the market of what a liquidation would mean for valuations, particularly, I think they own, down the twos and things like that based on where they, acquired that portfolio. So there's very much a high degree of concern in terms of what that's going to do, sales would do for valuations there. Then in addition, we saw volatility increase in mid-March with the SVB failure starting there, and rates, proxied by the 10-year rallied again. I think that was also related to SVB Bank and the banking collapse. Market was pricing in potentially, Fed easing or at least stopping in terms of their rate increases. So what we get to is the canonical, lower rates and higher volatility mean a wider mortgage spread, right? And then when that's combined with forward-looking liquidation concerns, this has driven the mortgage basis about 20 basis points wider than the Feb 2023 close, and sort of as this afternoon, we were trading at about 165 over the 510 blend. Now, and we've talked about this in the past, and my view is that, plus 180 basis points and wider is what I consider to be the stress level of the mortgage basis, right? That's where the mortgage market is beginning to signal that, there's stress in the marketplace, right? And we're just not there yet. I mean, close, but not quite, right? And then in addition, there's a relative value differential versus corporates right now. And so just looking at, spreads and looking at corporate index spreads, mortgage index spreads, when you use that metric, probably the advantage right now is to corporates, right? So either corporate spreads widen or mortgage spreads tighten. And I think we're at a little bit of a standoff coming into the summer because really we need some more clarity about SVB, and we have the overhang of those portfolios. So it's very unlikely that that mortgage spreads would tighten in the near term, but longer term or intermediate term is maybe a different story.
Yeah. So with that said, for intermediate term and year end, what is your forecast for the mortgage basis?
Yeah. So near term, if I were just to look at the mortgage basis and sort of say what is it cheap? Is it rich? Is it fair value? Then I would think that, I would say that it's cheap because it's trading at the upper end of its Bollinger Band range, right? So you say, well, I guess it's cheap, right? But that said, it looks like it's about 10 to 15 rich sort of versus its corporate alternatives. So near term, that puts me, sort of neutral on the basis. Intermediate term, once we get past SVB and signature banking failures, we get some clarity on the FDIC MBS liquidation, and the anxiety there sort of begins to maybe dissipate. Then I think the mortgage base is likely to tighten, absent further stress shocks or rates shocks or things like that. And so, I'm kind of forecasting that the mortgage basis likely closes the year around 120 basis points. So more towards the lower end of that basis range.
Got it. So really to sum up this episode, Glenn, you really believe discount prepayment speeds and turnover will be higher than the market consensus, that the mortgage basis will close the year around 120 bips at the low end of the range. But currently the basis faces headwinds from SVB and signature bank failures, as well as relative value competition from the corporate bond sector.
Right. Yeah, that sums it up nicely. That's pretty much it.
Great. Well, lots to kind of go over here. For anyone that's interested, Glenn is available for any follow-ups. And we'd like to thank everyone for listening to the MUFG Global Markets podcast. You could go ahead, rate, review, and subscribe on Apple, Spotify, or wherever you get your podcasts. And please reach out to your MUFG sales rep for any further information. And check back soon for more insights from the Global Markets Research team.